Do you have built up equity inside of your house and want to take out a home equity line of credit? Honestly, I think it's a great idea to put your home's equity to use in order to build you wealth and better your financial situation. Last year, I used a home equity line of credit on one of my rental properties in order to purchase a cash flowing duplex, and it was one of the best decisions I made. Now, even though I would count this as a success in using my home equity line of credit, it did not mean that I didn't make mistakes. And that's exactly why I wanted to make this video, to share with you 4 of the smartest ways that you can use your home equity line of credit and avoid all the common mistakes when using this loan product. Now, I just want to say, whenever using a home equity line of credit, there is risk. I mean, it is a loan against your property, so if it does default, they could potentially take your property away from you. But these 4 ways I'll be going over in this video are more of calculated risk, to where if you do your due diligence, you will be set up for success. As always, if this video is any valuable to you, please hit that like button. It would help my channel out tremendously. A HELOC stands for a home equity line of credit, and you can leverage that line of credit against the equity you have inside of your property. Think of a home equity line of credit very similar to a credit card, to where you get a limit, you can draw from it and pay it back as you please, and then use it again. But it's a little bit different. With a HELOC, you have 2 periods, a draw period and a repayment period. When you first take out a home equity line of credit, you are in the draw period, meaning that you can draw from it, use the money from your limit, pay it back, use it as you wish. Also, during the draw period, you can pay interest-only payments. But once the draw period term is finished, you now enter the repayment period, to where you cannot access any of the funds from your HELOC, you cannot draw from it anymore, and you have to start paying back the principal and the interest. Now, the first way is exactly how I use my HELOC, which is to invest in real estate. There are so many benefits of investing in real estate, and the fact that you can take your home's equity and go buy another property with it is honestly just awesome. My wife and I purchased this cash flowing duplex with a home equity line of credit, and after all expenses every single month, including the expense of the HELOC, we are still cash flowing $400 every single month. I highly suggest this option, but you really have to do your due diligence. When you purchase real estate with a HELOC, you're typically using the HELOC for the down payment and then getting a mortgage for the remaining amount of the purchase price. That means that you have close to no equity inside of that property, so if something were to happen and you had to sell it, you would not make any money and you probably lose money. So you really need to make sure that the cash flow is sufficient enough to not only pay all of your expenses every single month, but also allow you to net some, so that you could create a reserves account in case something were to happen, such as vacancies or an unexpected repair. So with that being said, here are 3 different ways that you can purchase rental properties with a HELOC and avoid over leveraging and losing that property. Number 1 is buying properties at a discount. This may mean to offer lower than what list price is on the market, or going out there and finding off-market opportunities to where you buy properties at a discount. When we purchased our 4-unit apartment complex, we purchased it for $430,000, and at the time of signing, it appraised for $450,000, meaning that we bought the property with $20,000 of equity, and if we needed to get out of that deal, we could have and maybe made a little bit of money. Number 2 is that buy a property that you can force appreciation into it through renovation, and through that renovation would create an equity spread for you. A great strategy for this is the BRRRR strategy, which is buy, renovate, rent out, refinance, and repeat the process. And lastly, like I did state already, make sure the property cash flows enough to where it can build a reserves account, it cash flows each month, and it pays all of your expenses. The next smart way to use your home equity line of credit is to restructure the debt you already have. I am a huge proponent of this, and I believe that everyone each year should look at their debt, look at their expenses, see how they can either eliminate or restructure it to keep more money in your pockets. With the cost of living increasing more year over year than the cost of hourly wages increasing, it is very hard to stay afloat. Whether you have racked up a ton of credit card debt with more than 20% interest on that credit card, you have high interest student loans, or you have a car payment to where the interest rate is just too high, using a home equity line of credit can be your solution to not only lower your monthly payment, but also pay less interest on that. What you have to watch out for specifically is the variable rate interest rate. So let's say that you have racked up $15,000 of credit card debt and they're charging you 20% interest on that. If you pull out your HELOC and let's say it's at a 7% interest rate with a variable interest rate that is capped at 10%, meaning that the interest rate cannot go any higher than 10% during the life of the loan, that means at worst it will go up to a 10% interest rate, which is still 10% or more better than the credit card that you have. This will be able to provide you with a lower monthly payment and a lesser interest rate. This is a great example of when you should use a HELOC to pay off the debt that you currently have. You are essentially exchanging lower cost debt for higher cost debt. The third smart way that you should invest your HELOC is to invest in yourself. Now, let me point out the obvious. If you struggle from shiny object syndrome, don't be that person that invests in a $20,000 course from an 18-year-old internet guru about crypto mining. In my opinion, that would not be a good idea in investing in yourself. What I'm talking about is to invest in yourself in positive ways. For example, one of those ways is to invest in your higher education. If you are someone in a career path that needs a higher education, like a master's degree, in order to get where you want to be, maybe start your own practice or get that higher base salary, then maybe investing in yourself with your HELOC would be a good return on investment. You can also invest into your company or business. Let's say that you have a landscaping business, you have tons of people reaching out, but you just don't have the manpower at this time. You could use a HELOC to go out there, buy more equipment, more lawnmowers, edgers, trimmers, whatever you need in order to hire those other people and get more lawns done. So with that HELOC, you would be able to increase the gross income you bring into the business by being able to do those other yards and hire those other people, as well as raise the valuation of your company. And lastly, learning new skills should never be something that you stop. You should continuously try to learn new things. I think you should exhaust all options when it comes to free resources, but I am a huge proponent, like I said, in investing in yourself and self-education. Now, this last way is very self-explanatory, but to use your HELOC for an emergency fund. Look, this is a great way to provide stability, and honestly, it may even make you sleep better at night knowing that you have that fund in case something were to happen or an unexpected expense comes up. Look, I understand, and I'm sure you understand life's hard. You have that unexpected health bill that you have to pay for that insurance won't take care of. Maybe you're driving to work, blow out a tire. There are times where you need to pull from some type of fund in order to pay for an unexpected hefty expense. So having that HELOC just sitting there would be a great option for you. And the best part about it is even though you took out a home equity line of credit against your property, you actually don't pay anything unless you draw from that HELOC. So take one out and just have it sit there in case of an emergency. There are 3 key rules that I go by and want to share with you as it applies to using your HELOC. Number 1 is HELOCs are meant for shorter term debt, meaning that whenever I use my HELOC, I have a plan of paying that off and having a zero balance on my HELOC within 5 years. The reason being that you don't want it long term is because there is a variable interest rate. This leads me into rule number 2, which is the variable interest rates. Now, whenever I analyze a deal and analyze if I should invest in something, my return on investment, I make sure to calculate it at the highest percentage that my interest rate could be on my variable interest HELOC. So when you apply for a HELOC and its variable interest rate, that means that it's based off of the prime rate of the market, so it can fluctuate up and down depending on how the market is. So if it's like today's market in 2023, then the interest rates will increase. Typically there is a cap, so what I do is I analyze any potential investment with the cap amount of interest rate just for worst case scenarios. And leading to rule number 3, which is have multiple ways to pay back your HELOC. If you invest the HELOC and you are solely relying on that investment to pay back your HELOC, that may lead to you not being able to pay back your HELOC and potentially losing your property. So that is why I make sure when I use my HELOC, I can pay it back either with my W-2 or another source of income that I have on the side. Now, if you're still very interested in taking out a home equity line of credit, or you have one and you don't know what to spend it on, make sure to check out this video next, which is what not to spend your HELOC on, or that could potentially put you in a worse financial situation. Thank you, everybody, and happy investing.